What is a stock? Have you ever wondered what owning a stock actually means? Think of a big company like a giant pizza. When that company wants to expand or build something new, they divide that pizza into millions of tiny slices. Each of those slices is what we call a stock. When you buy a slice, congratulations, you've officially become a shareholder. In other words, you are a part owner of that business. No matter how small your slice is, you have a stake in the company's future. In the American financial world, you'll typically encounter two main types of stocks. First, we have common stock. This is what most people are buying and selling every day. When you own common stock, you get a seat at the table, meaning you have voting rights on major company decisions. If the company prospers and the value of your slice goes up, you grow wealthier. But keep in mind, if the company goes bankrupt, common stockholders are the last in line to get paid after all the creditors and lenders. Then there's preferred stock. Think of this as the VIP version. You usually don't get a vote in how the company is run, but in exchange, you get a major perk. You are always first in line to receive dividends, which is your share of the profits. If things go south and the company shuts down, you also stand ahead of common stockholders to get back whatever assets are left. To put it simply, common stock is for those who want growth and a voice, while preferred stock is for those who prefer stability and a steady paycheck. How the market works. NYSE versus NASDAQ. So where do all these pizza slices get traded? Welcome to the stock market. Think of it as a massive global marketplace, but instead of buying groceries or clothes, people are bidding on pieces of the world's biggest companies. In the US, there are two giant stages where this happens, the NYSE and the NASDAQ. The NYSE is the classic. It's located on Wall Street and is known as an auction market. You've probably seen it in movies, a chaotic floor filled with screens and people in suits. Here, buyers and sellers compete directly with each other in a high-energy environment. It's home to legendary blue-chip companies like Coca-Cola and Walmart. On the other hand, we have the NASDAQ. This is a dealer market, and it's completely digital. There's no physical trading floor. It's sleek, fast, and tech-heavy. This is where the giants of the future live. Think Apple, Microsoft, and Amazon. If the NYSE is the old-school prestige, the NASDAQ is the high-speed engine of innovation. But how does the price actually move? It all comes down to supply and demand. When a company releases a revolutionary product or reports massive profits, everyone wants a slice. That's high demand. When demand goes up and the supply of shares stays the same, the price skyrockets. Conversely, if a company hits a scandal or loses money, investors rush to sell. That's high supply and low demand, which causes the price to drop like a stone. Essentially, the stock market is a giant voting machine. It reflects what millions of people think about a company's value every single second. Market indexes, the report cards. With thousands of companies trading every day, how do we know if the market is doing well? We look at market indexes. Think of an index as a report card for a specific group of stocks. Instead of checking every single company, you check the index to see the overall grade. In the US, you'll hear about three big ones constantly. First, the S&P 500. This is the heavyweight champion. It tracks 500 of the largest publicly traded companies in America. Because it covers so many different industries, from tech to healthcare, it's considered the best health check for the entire US economy. When people say the market is up, they usually mean the S&P 500 is up. Next is the Dow Jones Industrial Average, often just called the Dow. This one is a bit more exclusive. It only tracks 30 massive, well-established companies like Disney, Nike, and Goldman Sachs. It's like looking at the 30 all-stars of the business world to see how the big players are performing. Finally, there's the NASDAQ Composite. Since it's tied to the NASDAQ exchange we talked about earlier, this index is very tech-heavy. It's the go-to indicator if you want to know how the world of innovation, software, and biotechnology is doing. It's often more volatile, meaning it can swing up and down faster than the others. So why do these matter? Because they act as benchmarks. If your personal portfolio went up 5%, but the S&P 500 went up 10%, it means you actually underperformed the general market. Indexes tell you the story of where the money is flowing and whether the economic weather is sunny or stormy. Bulls versus bears, the animals of finance. If you spend any time watching financial news, you'll notice people talking about two animals, the bull and the bear. These aren't just mascots. They represent the two primary moods of the stock market. First, let's talk about the bull market. Think of a bull attacking. It thrusts its horns up into the air. This represents a market that is charging forward. Prices are rising, the economy is strong, and investors are feeling confident. In a bull market, people are eager to buy because they believe the future looks bright. It's a season of optimism and growth. On the flip side, we have the bear market. Picture a bear swiping its paws down. This happens when stock prices drop by 20% or more from their recent highs. Fear starts to take over, and investors begin to sell off their stocks to protect their cash. A bear market usually signals a struggling economy and a lot of uncertainty. But here's the most important thing to remember. Markets move in cycles. The transition from a bull to a bear and back again is a natural part of the financial world. A bull market can last for years, while a bear market might only last for a few months. Smart investors don't panic when they see the bear. They know that historically, every bear market has eventually been followed by an even stronger bull market. Understanding these cycles helps you keep your emotions in check. When the bear swipes down, it's often the best time for patient investors to find bargains before the bull starts charging again. Public companies and IPOs, going big time. Not every company is on the stock market. You can't just go out and buy shares of your local family-owned bakery. Those are private companies. Their ownership is held by a small group of founders or private investors. But when a company wants to reach the big leagues, they decide to go public. This process starts with an IPO, which stands for Initial Public Offering. Think of an IPO as a company's coming out party. It's the very first time the general public, people like you and me, can buy shares. Why do they do it? To raise massive amounts of money. This cash allows them to pay off debt, invent new products, or expand into new countries. Once the IPO is finished, the business becomes a public company. Their ticker symbol, like APPL for Apple or TSLA for Tesla, starts flickering on the screens at the NYSE or NASDAQ. However, being a public company isn't all glitz and glamour. It comes with a lot of homework. In the US, the SEC acts as the referee. They require public companies to release earnings reports every 3 months. These reports are like a public health exam. They show exactly how much money the company made, how much they spent, and what their plans are for the future. If the numbers look good, investors cheer and the stock price rises. If the numbers are disappointing, the market can be very unforgiving. For an investor, an IPO is an exciting opportunity to get in on the ground floor of the next big thing. But it's also risky because the company is now facing the intense pressure of the public spotlight. Valuation, PE ratio, and market cap. Now that you know how stocks are traded, the big question is, how do you know if a stock is a good deal? Just because a stock costs $10 doesn't mean it's cheap, and a stock costing $1,000 isn't necessarily expensive. To figure this out, we use two key metrics, market cap and the PE ratio. First, let's look at market cap, short for market capitalization. This is the total price tag of the entire company. You calculate it by multiplying the current stock price by the total number of shares available. In the US, we group companies into 3 sizes. Large cap, these are the giants like Microsoft or Walmart, worth $10 billion or more. They are usually stable and safe. Mid cap, mid-sized companies that are still growing. And small cap, younger, smaller companies. They are risky and volatile, but they have the potential to skyrocket. Next, we have the PE ratio, or price-to-earnings ratio. Think of this as the hype meter. It tells you how much investors are willing to pay for every $1 of profit the company makes. A high PE usually means investors expect massive growth in the future. They are paying a premium now for big gains later. A low PE might mean the stock is a bargain, or it could mean the company is struggling and investors are losing interest. Understanding these two numbers helps you see past the stock price. It's like checking the price per pound at the grocery store instead of just looking at the total on the package. It tells you the true value of what you're buying. Diversification and index funds, your safety net. Now, here is the secret to surviving the stock market. Don't put all your eggs in one basket. This is what professionals call diversification. Imagine you invest all your money in just one tech company. If that company has a bad year, your entire savings could vanish. But if you spread your money across tech, healthcare, energy, and retail, a bad day for one company won't ruin your life. Diversification is your financial seatbelt. But picking 50 different stocks one by one is a lot of work. That's why many smart investors use index funds or ETFs. Instead of buying just one slice of pizza, an index fund allows you to buy the whole pizza shop. For example, when you buy an